I do think we will see the shift to principal lenders, balance sheet lenders, and private capital. I think if you're in a position where you've now got committed funds, you stand to do well, or you'll be leading from the front, if you like, in a situation like this.
I think there is a concern that there are a number of short-term and development lenders who are funded by the same institutions, and if one of them are impacted, then they could all be, which means less.
Yeah, I think you're right, and all of the platform lenders have parameters that they need to stay within to satisfy their loan on loans. And the question will be is if there is a shift in values, for instance, and they breach those covenants, which means there's a cash call for them to satisfy, whether they'll be able to satisfy it, and if they can't, what the impact of that will be.
I think that is a concern, Ed, and I hear that from many where they've accessed liquidity lines, and I think the alternative lending market has become quite sophisticated in its approach. That they access repo lines, CMBS lines, private money, junior capital, and there are managers out there who are very sophisticated and pull together multiple sources into a structure to then on lend. And many of the borrowers of that money are completely unaware of the structure that sits behind them, and it only needs one of those threads to be pulled because the CMBS market is closed, and therefore they can't issue new paper, or they can't issue new paper at the correct price, so they can't put money in. That means there's a shortfall funding. Next quarter's construction drawdown. You only need a thread to be pulled, and it can cause huge problems. And as Ed said, I am almost certain there will be lenders out there that will have cash calls because their underlying providers are struggling or looking at ways of recapitalising money, and are therefore putting pressure on the lenders. And the lenders will then need to find a way of meeting those cash calls. And as Ed said, that was some peer-to-peer lenders fell foul of that historically, where they would enter into obligations without necessarily having all the money in the bank to meet those obligations. There was a requirement for them to raise further money in future periods to meet their obligations, and in some cases they couldn't do that, and that is unfair on the borrower who has borrowed that money because they get caught short.